I'm here in Mallorca, Spain, and we are broadcasting this live. So if we make mistakes, there is no way to save us. I'm here with our host, Rob Ferry, and he's the CEO and founder of Flying V, our digital marketing partner. He also moved last week. It's a very exciting week for him. Rob, how you doing?
I'm hanging in there, but no, I'm excited. Really fired up this morning. I know that we're live at 7:21 a.m. here on the West Coast. Beautiful morning in Southern California. We had a heat wave over the weekend, actually, of course, right? The one weekend I was moving, and heat wave, I know, depending on where you're coming from, but hey, it was 86, 87, 88 down by the coast. So it was hot, it was warm, but we got through it. Ready to rock and roll. And we stayed hot right into Monday morning, which before we even get into the chairman's issue of this week's 5 things to know in investing, we're going to do something a little bit different with I don't know, maybe we need a DKI alert with a red flashing lights here. Gary, SC Pharmaceuticals announcement, acquisition from Mankind. Before we even jump into this week's 5 things or even tell you what we're going to cover there, we want to talk about this. This is a DKI portfolio position. Gary, I know you got a lot more information than I do, and I'm sure the rest of the streets. What are people saying about this acquisition? What do you know, Gary, about SC Pharmaceuticals?
Yeah, so Rob, this has been a portfolio position. It is the second medical device company that we've owned that's been taken out in the last 2 years. Our third acquisition of a portfolio company for a big premium in the last 4 years. That's worked out really well. Tons of credit on this one goes to DKI board member and cardiologist, Dr. Paul Thompson. He was the one who originally suggested the idea and certainly helped with the research. What SC Pharma does is they make a diuretic that's used for congestive heart failure and for chronic kidney disease. And these are diseases where people end up having swelling issues. They retain fluid and it's dangerous and very painful and needs to be alleviated. And SC Pharma's solution is about a 75% discount from the current standard of care, which involves hospitalizing people or sending them to infusion centers. It's safer, it's more comfortable for the patients, and saves Medicare an enormous amount of money. Mankind jumped on it and announced this morning they're acquiring the company for a big premium to Friday's close and also to our purchase price. This was one of those positions that we kept confidential for DKI premium subscribers only. The best I can tell you is that had you been a subscriber, just this one deal alone would have paid for years and years of your subscription fees. So, maybe consider the value of that. But either way, thanks for listening to this now. We're glad to have you as this part of it. But we've done really well in these names, and we keep finding these small pharmaceutical or medical device companies that get acquired. The deal is for $535 in cash, plus a CVR that stands for contingent value right, which will provide shareholders with up to another $1. We're currently valuing that now. Back of the envelope, it looks to me like the market is valuing that CVR at about 26 cents. And I do think there's a high probability that you get the full $1 of value here. So as of right now, we're still analyzing it and going through the agreement and the releases. And I was on the conference call this morning, but I haven't sold that stock yet, despite the fact that it's up a lot.
Yeah, and I think one of the things to note is, and that was going to be my question, Gary, what are the next steps? But I know also as part of the premium subscription, right, we're not going to let you know when we close out these positions as well. But yeah, it has been a great run. Obviously, the board of advisors showing great value just with Dr. Paul Thompson and the rest of the board of advisors that we have here at DKI. So I just wanted to tip my cap to you. Obviously, I'm a SC Pharmaceutical shareholder, so obviously a fun morning over here as well. But yeah, just congratulations to you and the rest of the team, Gary, on the research and the insights that you had on this one. And I know plenty more to come because, hey, kind of getting a little bit of a consistent track record here going on.
Yeah, we've done really well in these names. And, people sometimes ask me about how we use the board of advisors. And it's worth pointing out that in just the last week, we had this takeout, which, of course, credit to Dr. Paul Thompson, cardiologist on the board. Just last night, I was on the phone with Raji Kabaz. He was my partner at Silver Arrow, great hedge fund guy. We were discussing an accounting issue related to a different investment. I was talking with Howard Friedland, who is a real estate advisor, about a variety of things and some internal governance. He's been a great compass and keeping the firm pointed in the right direction. Really just a great advisor there. And then not announced yet, but in the next week or two, we will be adding a new member of the board, specifically in the field of AI, because obviously we need expertise in that area. And that individual and I are on the phone probably 4 or 5 times a week. So that's just in the last week. I'm talking with people on the board all the time and being very well advised.
Yeah, great stuff. So if you're just now joining us this morning, SC Pharmaceuticals acquired by Mankind, big win over here for Deep Knowledge Investing subscribers, especially premium subscribers who were in very, very early. And I know we kept this one more or less under wraps. A lot of great stuff. Yeah, Gary, the med tech space has been biotech, obviously always very exciting, but these acquisitions too. And then I was even in a position, not DKI related, but Theramune. Check that out, ticker THAR. And that one was up a little over 200% at one point last week, and very similar space as SC Pharmaceuticals. So yeah, let's keep them coming. And we love all the time being spent in those particular research spaces. But Gary,
Rob, maybe we're going to have to start a hedge fund managed by you.
No. I don't know about that.
It's going to be the Friends of Therian Fund.
I like that. Okay. That sounds pretty good. That does sound pretty good. See, you are a marketing guy, Gary, as much as you don't want to admit it. You are.
Just don't ask me SEO questions.
All right. That's fine. I can handle those. All right. Moving into it. Let's get into this week's 5 things. Great way to start off the week. This is the Chairman Speaks issue. Again, we're going to cover the 5 biggest topics, things to know in investing for this week, as well as get some educational content and material in here at the end of the show. Should be about an hour, if not even a little less. Tends to vary just based on topics, how deep we need to jump into it, how much maybe I might know to be a little bit dangerous and ask all the right questions. So, Gary, this week we're talking Chairman Powell making an appearance, copper back in the fold, Bitcoin, of course. We got SoftBank making appearance, something having to do with the CHIPS Act. And then finally, to close things out, we're talking about the basics of futures contracts. Actually, had someone ask me, how do you trade futures? How does that work? So we'll cover that and jump right in. Gary, first thing.
My advice to that person, though, is if you have to ask that question, don't do it. If you don't know what it is, do not put capital at risk.
That's why we're here. So here we go. Gary, thing number 1, again, as I mentioned, we're talking about Chairman Powell. He is all the rage. It's almost like this hero, villain, hero. No matter which side you're on, you have one or the other, right? With President Trump. Thing number 1, Powell at Jackson Hole hints at rate cuts. Here we go.
Well, so it's interesting that you talk about the hero villain aspect of it. I'm on record saying I disagree with both sides. I think Chairman Powell, he's done a poor job. He kept rates far too low for far too long. He was very slow in raising rates. He was far too early to start cutting. And a ton of the inflation that we have right now is due to his actions, and on his watch, he's responsible for that. He hasn't done a good job. However, President Trump criticizing him in public in the way that he has, I think, is counterproductive. And basically trying to berate him for lower rates, I think, is beyond unseemly. It also isn't going to get him the result that he wants. Lower overnight rates are not going to lead to lower 5 and 10-year rates. Those are the rates that people use to borrow. So I don't think that gets the solution the president wants. In this matter, we disagree with both sides. So maybe we can say villain on this. Anyway.
Pretty good. That's Powell, good marketing right there too, Gary. I mean,
right.
Geez, keep them coming.
There you go. And by the way, I don't think either of these two men are villains. I just think Chairman Powell has done the best that he could, but he hasn't done well. And I understand why any president wants lower rates and bigger economic growth, right? That's how ultimately how American presidents are judged. I understand why President Trump wants it. I just don't think the way that he's trying to go about doing it is going to result in what he wants. That doesn't make him a villain. I don't think he's a bad guy for wanting more economic growth. I just think the way he's going about it is not going to get the result he wants.
Gary, and for DKI subscribers that are listening to this right now, I think you know the question that I'm going to ask, but I have to do it. With these likely rate cuts, I mean, what are you doing for the DKI portfolio? What does that look like? What's going to happen? And apologies for those that already know what this answer is going to look like.
Yeah, well, let's start with end the Fed, but I'm not going to get that, right? That's always number one on my Christmas list. But you know what, Rob? Let me answer that question in two parts. The first part of it, let's talk about what the chairman said at his Jackson Hole speech. Basically, what he did was he talked about the fact that we have inflation that's too high. Tariffs may lead to higher inflation. He's saying that'll be transitory or one time. You know, we love hearing that from the Fed, but I actually agree with him. I think any inflation coming from tariffs will be transitory. It will be one time. You know, we made fun of him for that a few years ago, but I think on this one, he's right. But what he's doing is he's taking a look at a labor market that's a little bit weaker than people had wanted. It's not awful. And he's saying the balance of risks is now in favor of the labor market. And what that is just sort of a subtle way of saying that what he'd like is higher rates to control inflation, but lower rates to ensure we remain at full employment and that people are able to get jobs. Those two desires push against each other. And when you hear people talk about the Federal Reserve having a dual mandate, that's the push-pull of that dual mandate, right? Higher rates for lower inflation and lower rates for higher employment. Okay, that's the push-pull there. And what the chairman is saying is things are now leaning more in favor of the labor market. And the market is reading that, and I think correctly so, that Powell is leaning towards, depending on where the next CPI comes out and the next PPI comes out, and you know we'll get some more economic data, but he's leaning toward reducing rates at the September meeting just next month. Okay, so look, I disagree with that decision. You may agree, disagree. Feel free to put it in the comments either way. You know, if you agree or disagree, just give us the reason why, right? Cool either way.
People on the live right now, they're throwing things at you actually, Gary, but that's okay.
Oh, really?
Yeah.
That's
I'm
fine.
Kidding. Well, they might be.
All right. All right. Just listen, you're welcome to agree or disagree. Just tell me why. Just use the word because, right? Like, you suck, rates should be lower. I have no idea what to do with that. Okay, so here's the thing. I disagree with the decision to lower rates right now, but it doesn't matter what I think. The job here is to make money. And so with a lower coming Fed funds rate, I think what we're going to see is a couple of things. We're going to see a steeper yield curve. Don't panic on that. Just a fancy way of saying lower short-term rates, higher long-term rates. This is what I was saying. The president is wrong in his analysis. If you get lower short-term rates, the bond market will price in higher future inflation and you'll get higher long-term rates. So that would be a steepening of the yield curve. But what all of this does is it juices the prices of risk assets. Well, what does DKI own? We own a huge amount of inflation protection. We own small cap, ultra high growth stocks. We own gold, we own Bitcoin, we own energy, specifically uranium, and more economic growth means more energy usage. A weaker dollar means higher dollar prices of energy. Hey, guess what? I don't know, we don't run one portfolio for everybody, but I can tell you that my personal portfolio was up almost 4% on Friday. That's an enormous one-day performance. And the reason is because whether I agree or disagree with the decision, we were very well positioned at DKI to profit from it. And that's the job. That's what we're trying to do. By the way, worth pointing out, that was before the SE Pharma takeover.
Yeah, I mean, Gary, I think you nailed it. And same thing, Friday was also a great day in the sense that DKI's job, and you've always said this from day one, is to position our subscribers, for the market, regardless of these decisions that get made at these levels, right? You mentioned villain, hero, whatever you want to call it. It's interesting.
Yeah.
You're disagreeing with how things are being handled on both sides, right? But a decision's going to be made. And then what decision gets made, that's where we come in terms of already being ahead of that and understanding if this happens, then this. So Gary just continuously doing a great job to position DKI subscribers for whatever happens in the market, no matter who we get in there making what decision using whatever pen. But Gary, let's keep it moving. Thing number 2, great discussion there on the Fed. Gary and everything from Chairman Powell. And yeah, hey, my good buddies Troy and Winston, I actually got to do a shout out. They're the co-founders of Saws, but Winston's he lives in Jackson Hole, got engaged over the weekend. Him and Courtney, his bride. Congratulations, Winston. Maybe you can celebrate with Chairman Powell out there in Jackson Hole. But anyways, all right, thing number 2, we're talking copper tariffs. Gary, so saw a lot of movement here in these markets. Thing number 2, copper futures plunge following tariff reversal.
All right. So effective on August 1st, President Trump reduced tariffs on copper from the previously planned 50% and just took them down to 0. So what that means is companies can import copper without this 50% tariff. If you don't know what a futures contract is, stick around. We'll talk about it at the end of the show. If you don't know what a futures contract is, please don't trade them. Anyway, moving on. The reason this matters is because the nickname for copper is Dr. Copper. And the reason it's called Dr. Copper is it's really good at telling you what's going on in the economy. Generally, copper is a great proxy for economic growth if you're building buildings, if you're building things, and pretty much anything you build requires copper. And so it's a really good proxy for industrial growth. And one of the things that some really smart economists have done is when we're looking at economies like China, where they deliberately don't report accurate information. And by the way, if you want to point out that the economic reporting in the United States has been accurate, we agree with you. We talked about that in last week's episode. But anyway, one of the things that people do is they say, you know what? I don't care what these institutions or what these government organizations announce. We're just going to look at what happens with copper. And it's a pretty good proxy for growth. So that tariff got removed and copper prices plunged right away. Great. Copper prices on the COMEX, that's the commodities exchange, were down 17% after weeks of price increases. And then the other thing worth pointing out is that the tariffs remain on semi-finished goods. Those are things like pipes, tubes, wires, other components. So again, Dr. Copper, like, when are you using pipes, tubes, wire? It's when you're building stuff. So that's what's going on there. The one other piece of information on this that's worth relaying is there is some focus on Chinese use of slave labor. That there are parts of China where they're using Uyghurs for forced labor. And there is an effort right now to ensure that in the United States, we are not buying any copper from that part of the world. It's designed to address both unfair trade practices and human rights objectives. You can, I'm sure, understand why we don't want to be buying things that are made with slave labor.
Yeah, no doubt about that one, Gary. Caught me off guard with that. But yeah, so with that last point, Gary, my question is, with this supply chain, right? You look at copper, all different other sorts of resources, right? Why protect just part of the supply chain and not all of it? What's the strategy behind that move?
So I actually think, and I can't believe I'm going to say this, I actually think the government got it right on the policy. I know this is not like me to be, praising government economic policy, but here we are.
You okay with that?
It's right. Okay. Blink if you're under duress.
Yeah, yes, exactly.
All right. So here's why I actually think they got the policy right. As we just discussed, you need copper for economic growth. You want to build things, you need copper. Okay, so what we want is a free flow of copper into the country, but we also want to encourage domestic manufacturing, in this case, finishing. So what we're saying is, let's make sure we have the raw materials we need for economic growth. And then in addition to that, let's make sure we encourage American companies to make these, components like pipes and tubes and wires, things like that. So it actually fits the White House's goal of greater economic growth with greater domestic manufacturing.
Makes sense, and definitely something that's going to be interesting to see how that plays out. And yeah, I know the copper markets, like you mentioned, that proxy is always so curious. Gary, how does that throw off that proxy? I mean, are people still going to be using that in similar ways, or how do you make any adjustments with how closely that had been aligned?
I don't think you have to. You don't have to look at it from a price point of view. You look at it from a volume point of view,
Okay.
right? So you say, last year you used a certain number of pounds of copper. Okay,
Yeah.
this year we used, I'm making this up,
Sure.
5% more. Okay, well,
Got it.
It's pretty easy to see. Then we built 5% more stuff, right? Regardless of the dollar price of it. Right. Let's separate price and value there. So
makes sense. Cool.
Yeah.
Great stuff there, Gary. Moving on to thing number 3. And before we do that, head over to deepknowledgeinvesting.com. Check out our premium subscription, $100 a month. That'll get you access to the full portfolio, buy, sell orders coming from Gary, research topics, exclusive access to board of advisors who we mentioned earlier, companies as well. You could always sign up for a free subscription. Also, that'll get you added to our mailing list. You'll get this written version of the 5 things delivered to your email and a bunch of other good content that'll come out that is not gated. I would love for you to join the DKI family in that way. It costs absolutely nothing. We got a lot of new fun stuff coming out, AI related products, the Ask Gary feature on the website getting a revamp, but that's easy to use right now. And you can always email us IR at deepknowledgeinvesting.com. We're shifting to Bitcoin on this week's version of the 5 things to know in investing, the Chairman Speaks issue. Gary, Bitcoin, we're talking volatility. I know you had a thread on X over the weekend that I think got some legs and going. So just a bunch of growth all over the place. So that was exciting for me, the marketing guy, I guess, right? But Gary, thing number 3, Bitcoin volatility and the path to becoming a currency. Exciting stuff. A lot of good names going to be thrown around here as well with a lot of good insights.
Yeah, so it was kind of fun seeing this thread on X. It did get a lot of attention. It got hundreds of thousands of views, hundreds of likes. Really nice, great retweets from the people at OnRamp Bitcoin, Lawrence Lepard, Lynn Alden. And the issue, I think the reason it got so much attention is it addressed an important issue. I regularly talk to people who say there's no use case for Bitcoin because it's too volatile to be used as a currency. And, they ignore that it's becoming a store of value like gold and ignore the flight to Bitcoin in countries with extremely high inflation rates. It's really easy to say, well, it's volatile in dollars. But, if you owned Argentinian pesos pre-Mili, or if you were in Lebanon, Bitcoin was your escape hatch. And, Bitcoin wasn't volatile in those currencies. So they ignore all that. Listen, I don't agree that there's no use case, but I do think that it's really important that if we're going to be persuasive, we have to address the arguments being made. And, Bitcoin has been volatile versus fiat, and prices tend to be posted in fiat. And so that adds to this perception. But the problem with that argument against Bitcoin is that it's static, and you should look at the dynamic picture. In this case, we had new star intern Gideon Rodham, who is a math major at Dartmouth, and we had him run the correlations and the volatility. And, we posted a bunch of charts on X. We included 2 of them in this week's version of the 5 things, but we posted the daily volatility by year. And if we go back to 2010, when Bitcoin first started trading, it was 14%, and then it dipped. It was back up to 12% a few years later, and then trended around 4 or 5%. And that daily volatility is now down to right around 2%. Now, somebody might say, well, wait a minute, 2% daily volatility, that's a lot. Sure, it is, but it's down from 14%, and it's down from 12% from, a decade ago, and it keeps falling as we get a higher market cap and greater institutional adoption. So I think, these are things worth looking at, and I expect that trend will continue. The other thing, the other chart that we posted was the Bitcoin price versus the purchasing power of the dollar. And the Bitcoin price has skyrocketed, and it's done so in a volatile way, whereas the dollar has lost value very consistently and slowly. And, since Bitcoin started trading, the dollar has lost roughly one third of its purchasing power, one third of its value. That's just since 2010. And that's, by the way, if you think the CPI is accurate. I don't. I think the CPI is understated, which means you've lost well over one third of your purchasing power in that time. So, I think that a lot of these arguments related to volatility they're just looking at yesterday. And these things should be forward looking discussions.
Crazy just to hear you say that, right? And how often people just get stuck in what happened in the past and yesterday versus, yeah, you got to be forward looking with everything that is happening. And I mean, even speaking to our first point on what's coming, with the Fed's position, etc. And then, okay, so Gary, to break this down, and the charts do it really well, so really encourage you, head over to deepknowledgeinvesting.com. Just give us your email. We'll send you over this version of the 5 things later this week. So it looks like Bitcoin's volatility obviously has reduced dramatically. What's the best approach here, right? And we know we've been talking about, hey, the dollar's purchasing power. That was one of the things that I always talk about with people, to just kind of, hey, we don't know if Bitcoin's going to be at 50,000 or $1 million a month from now. But what we do know is that the dollar's purchasing power is going down, right? I mean, that's the most simple way I can put it, and I don't know what your argument would be on the flip side of that. So, Gary, what's our approach here? And again, I highly recommend everybody go grab a copy of the written version so you can see all these graphs. Check out Gary's thread as well on X. But Gary, what's the approach?
Yeah, so I think there are a couple of things, a couple of ways of looking at this, Rob. One is, people are saying, hey, wait a minute, that you've got like 50% volatility annually. Okay, great. But take a look at the price vol of the Magnificent Seven or various commodities. We just talked about copper moving 17% in a week, right? And yet they don't face those arguments. Everyone's fine with NVIDIA and Microsoft. Those stocks are volatile. They move more than 50% in a year, and it tends to be up. Hey, guess what? The same is true of Bitcoin. All right. But anyway, I would just make 2 points on this. I thought there were a ton of great comments on the thread on X, but my favorite of all of them came from Lawrence Leopard. He wrote, actually, it's the dollar in Bitcoin terms that's quite volatile. Bitcoin is stable. And I think that's a brilliant way of looking at it. And it's actually similar to something I say about gold, right? And I've owned gold for 5 years. It's more than doubled for me and for DKI subscribers. So that's great. But, people say, oh, well, gold is up. And my response is no, gold purchasing power is roughly stable. It's the dollar that's losing purchasing power, right? We're gaining in dollar terms. And so again, earlier in this episode, we were talking about, how do you make money where the Fed is cutting rates? Well, this is one of the ways to do it. And you have to think about these things in the right way. We're positioned for that. But, for people who are still uncomfortable with this, and I understand why you would be, I'm just going to leave you with one question and really just think it through. My question for you is, do you want to gain purchasing power with high but decreasing volatility in Bitcoin? Or do you want a 100% guarantee of losing purchasing power slowly in the dollar?
Great question and great way to put it. If you agree, disagree, leave it in the comments. Let us know why. Would love to see the flip side of that argument played out. But yeah, Gary, I mean, I think it's an absolute no-brainer, and we've just seen it consistently play out, as you've mentioned, over the last 3-4 years since you've been talking about these things. So again, head over to deepknowledgeinvesting.com, grab that free subscription. That'll get you the written version of the 5 things that'll get fired out later this week to free subscribers. Gary, moving forward, we're talking SoftBank. Mentioned it earlier in the show in the intros. The group we're talking about alongside of them is Intel. Gary, thing number 4, Intel's investor comeback with SoftBank. We're talking about a $2 billion position. What do we need to know?
Yeah, so Rob, when we first started writing this, the SoftBank $2 billion investment in Intel, that was the big news. And when that deal was announced, it caused the stock to rise 7%. After that, Intel announced it was seeking additional equity infusions from other large investors to strengthen its balance sheet. And that caused the stock to fall by 7%. Okay, so up on the deal, down that they were looking for more. And then the White House got involved. President Trump, he has been all over the place on Intel. First, he said that Lip-Bu, the new CEO of Intel, had to resign because of his prior connections to China. Then he met with the CEO and said, okay, I believe him that he says he's going to do the best he can for the company and to keep manufacturing in the United States. And now he supports him. There was also talk that the government wanted to take a 10% stake in Intel. Then they said they didn't want it. And guess what? Now they're getting it. When Lip-Bu went to meet with the president in the White House at the end of last week, he got the help he was looking for on it, but the president reversed his stance in the White House meeting. Now he's backing Tan, but also the government is going to take a 10% stake in Intel. That'll go up to 15% if Intel spins off its fab plants. Right now, Intel is it's vertically enabled, meaning they design chips and produce them. If they spin off the production part of it, the government share will go from 10% to 15%.
Gary, what's really what is the big complication here? And is there a good solution, or why is there no good solution, or how can these two sides, make this work?
Yeah, so there's no good solution here. I don't like this deal, and I don't have a solution for something that would be better. Here's why it's so complicated. Um, what has happened is, with the exception of Intel, the vast majority of the high-end chips in the world and the very best chips in the world are all made in Asia. China supports their domestic chip manufacturing business to the tune of about $150 billion a year, which is just a huge number. On top of that, Taiwan, which may potentially fall under the control of China, is where the best chips in the world are made. So if you're the United States looking at that, you say, okay, wait a minute, this is a gigantic issue. It's a gigantic national security issue. We need chips for all of our weapon systems, right? So if we end up in a conflict with China, what are we going to do? Say, hey, keep exporting us the chips that we need, for our weapon systems. This is a gigantic problem. The United States does need domestic chip manufacturing capacity. And so the prior White House said, okay, we're going to take $40 billion and it'll be the CHIPS Act, and we're going to give it away to companies that agree to build fab plants to build production capacity in the United States. And I looked at that and I said, okay, well, I don't like this. I don't like the idea of the government giving away tens of billions of dollars. I don't like the idea of them picking winners, but I really don't like the idea of us not having domestic chip manufacturing capacity. So I said, okay, ultimately, I see why the White House is doing this. And, they seem to be pointed in the right direction. Well, basically, President Trump, the representative of the American taxpayer, again, reasonably said, well, wait a minute. Hey, Intel, you're getting about a quarter of that $40 million, right? It's somewhere in the neighborhood of 10, $11 billion. Shouldn't we get something for that? And guess what? The president's being reasonable. Why should American taxpayers be giving money away? And just think about it. Like, we didn't like the bank ballots in 2008. Do we want tens of billions of dollars being given away now? Now, the amounts being given away now are much less than they were in 2008. And I do think chip manufacturing is much more strategic and important. We do need it. Whereas, had some of the banks failed, I don't think it would have been the end of the world. But it's really complicated. Then, to make things even worse, the deal that Intel had with the prior White House was, okay, you're going to give us $10, $11 billion and we'll build fab plants. Now Intel is being told, hey, guess what? We also want equity, right? We're changing the deal. This falls under the category of we're going to make them an offer they can't refuse, right? It's a Godfather quotation.
Mm-hmm.
And so, I don't know the right answer. I think it's a bad idea for the United States to strong arm companies into giving the country to giving the country equity stakes. I further worry that a different White House could then basically government controlled equity stakes. At some point, we're going to have a guarantee of non financial DEI style meddling. And if the whole point is we need high end chip manufacturing, then that needs to be the goal. And we shouldn't be using these things to further certain social programs or certain social goals or race based goals. It really needs to be about competence alone, regardless. And so, it's the whole thing is it's a mess. It's going to be a mess, but also having all of our high end chips made in Asia is a national security problem. I think the execution here is going to be difficult. So it's a long way of saying I don't love this deal, but I don't have a better suggestion for how else to do this. And for the libertarians in the crowd, for the people who just want pure capitalism, I'm with you. I think that would be ideal. But then what happens? If the Chinese government is directly supporting their domestic chip manufacturing business and we lose that capacity. And we've spent 40 years outsourcing a huge amount of our manufacturing capacity. And as a result, it's led to enormous problems. And, other countries now have capacity that we lack, and we are now at their mercy. And I don't want us to be there on chips. So long way of saying this is really complicated. I don't see a good solution for any of it.
Yeah, very interesting dynamics at play there, Gary. We'll keep you in tune with how this plays out. And thank you to the DKI interns on that one. A lot of good research as well as everything else throughout the rest of the show. Always want to make a call out to them. Gary, I know you do a good job of that at the end of the show. Final thing for this week, we move into our educational topic. Again, we're talking about understanding futures contracts. We made an appearance, obviously, earlier in the show with copper, talking about that. Gary, let's get into the fifth and final thing. What do we need to know about futures contracts?
All right. So a futures contract, it sounds complicated. It's actually really, really simple. It is simply an agreement to buy or sell a commodity or financial instrument at a predetermined price on a predetermined date, a set date. That's it. So what you're doing is locking in the price today for a transaction that will happen later in time. Just like securities, the contracts are standardized and traded on regulated exchanges. So for example, Rob, you and I could have an agreement that says I'm going to sell you a certain amount of wheat on a certain date at a specified price. And that's all it is, right? And commodities are the most common underlying assets for futures contracts. The most common are things like wheat, metals, energy products, things like oil, gold, copper, we were talking about earlier in the show. But financial instruments can also serve as underlying assets. And in fact, even cryptocurrencies or Bitcoin, one of the ways that that companies were able to get the SEC to approve the Bitcoin ETFs was to say there are futures contracts. There's already a market in this. You might as well allow more standardized purchase of these things. So the key thing here is you do have a lot of speculators in these markets, but it's also important to understand that producers will use these kinds of instruments. So for example, like let's say I'm a farmer and I produce a certain amount of wheat. And let's say I need to lock in pricing and I'm worried that pricing will fall. So I would say, okay, Rob, I'm going to have wheat. Here's when I'm going to harvest it. And I will deliver that wheat to you, on a certain date, but let's agree on the price. Now I want to lock that in because I don't want to be in a position where the price can move and I make money once a year. I'm going to lose that money. Right? Oil producers do this. You also have, like, as an example, companies like cruise lines, they regularly hedge out fuel costs. Right? They know they're going to need a certain amount of fuel oil to run their boats, to run their ships. And so what they'll do is they'll buy that in advance. They'll buy a few years out. They have a pretty good idea. So these are important instruments that companies can use to lock in profits, to ensure they don't lose money, to have future supply guarantees. We see it a lot in the uranium market as well. These aren't standardized things, but like Cameco has long-term supply agreements. They're effectively futures. They're just private, not publicly traded.
Makes sense. Gary, I know there's two important terms that we want to touch on in regards to futures markets, contango as well as backwardation. Gary, let's start with what is contango as it relates to futures markets? What is contango?
Yeah, so it sounds complicated. Again, the reality is much more simple. Contango is simply when futures prices are higher than the current spot price. So, for example, if gold is trading at, $3,400, but a gold future is trading at $3,500, that's contango saying we expect prices to rise. And then backwardization, so that one's hard to say. That's the opposite. That's when, yes, exactly. There you go. That's when the market is expecting prices to decline in the future. You're saying, okay, the price today is here. The price tomorrow will be a little bit lower, or a month from now, or a year from now. That's what that is.
Great stuff there, Gary. That'll wrap up this.
Hang on,
sorry.
we're not wrapped. There's one other key thing here.
I missed it.
It's really important to understand. There is a hilarious example that every young trader is informed of. We are used to thinking of financial instruments as sort of these abstract things. You own shares in a company, you don't have to take delivery. But it's important to note that in most cases, futures actually are sold or bought on actual stuff, things. There's delivery involved. You need to know if you want to take delivery or not. And so every young trader is warned of the occasional story of someone thinking they had big profits in a futures contract. They only thought in terms of abstractions instead of physical goods. And then they didn't sell that contract before expiration. And then they got a phone call asking where they wanted some huge quantity of actual physical oil, wheat, or other goods delivered. Like, what do you mean? Yeah, you bought this, right? Now we're going to deliver it. I'm like, oh no, right? And so it's really important to know if you want delivery or not. If you're a cruise company, you probably want delivery. You probably want the oil. If you're a farmer, you intend to deliver the wheat. But if you're a speculator or just trading on something, you really want to sell that contract before expiration if you don't want to take delivery. And I remember back in, I think it was 2020, when oil prices went negative, I had people saying to me, well, wait, oil prices are negative. Why don't you buy it? I'm like, because I can't store it on my lawn. Right? Like, you have to take delivery.
Yeah, that's great. That's awesome. Words of wisdom from Gary Broad. You have to take delivery. That should be on a t-shirt too. So we got a bunch of zingers this show we'll have to pull out. Nazim,
we need merch.
We need merch, whatever else we can come up with. And the Fed, you got it, you name it. So Gary, as always, great to do this with you. This is the Chairman Speaks issue of the 5 Things to Know in Investing for this week. We'll be here same place, same time next week. Thank you so much for tuning in. Actually, Gary, is next week same place, same time with Labor Day?
Yeah, we are on.
Okay.
The interns are working on this week's version as it is, and Rob giving you the long weekend off.
Yeah, right. That's what it was. I will be.
We're gonna have Mark Rosano, fellow hedge fund manager, private equity guy, and energy expert. He's going to be filling in for you. So that should be, a fun conversation with Mark. He's always a really good guest host.
Yeah, Mark's awesome. And so, we'll be same place, same time next week. I'll have a guest fill in. Looking forward to seeing everybody in a couple weeks. Gary, turn it over to you for the closing thoughts.
Yeah, so first of all, a round of applause for the DKI Board of Advisors, in particular, Dr. Paul Thompson, cardiologist, who suggested both Shockwave Medical 2 years ago, that got bought out last year, and then SC Pharma, which we bought last year, and the company that was announced that they're being acquired at a big premium today. We're all making money. So thank you to Dr. Thompson on this. Rob, thank you so much for doing this. Really appreciate you and the team at Flying V. For the people watching this, if your marketing guys are not filming shows like this with you, ask why they're not doing more for you and give Rob a call at Flying V. I'm sure he'd be happy to hear from you. And then, of course, we always want to give credit to our young interns who are doing a terrific job. Cashin Crow from the University of Tennessee, Samak Jain from Rutgers, and Gideon Rodham from Dartmouth, whose math major skills were put to work this week on those great Bitcoin charts. You can check my X account to see all of them. Great job by these young students. They really do a terrific job. I wish I would have been that prepared when I had been their age. And then finally, for everybody watching this, thank you so much for your time. We know it's valuable. We appreciate you spending it with us. If you want to give us a like and to subscribe, we'd appreciate it. But hey, do what you want. We're not the boss of you. We'll see you next week.
Thanks, everyone.